PowerPoint lecture. Okay, today we'll talk about the variable cost and analysis. All right. Let's get started this week. First of all, I hope everyone's doing well. Okay, make sure to, obviously, big thing to keep up with your assignments. Remember, your grades are updated every week. If you have any questions, comments about your grades, of course, come see me. Okay, objectives, again, the big thing is we talked about this week's chapter is, absorption and variable costing. The big thing we're going to be estimated, what is the unit cost for each one? What's it going to be under absorption costing and variable costing? Again, they include certain things for cost method, variable cost of materials, absorption of materials. The big difference is going to be right here. And variable costing does not include fixed overhead in their cost per unit. Absorption does. The name says it absorbs everything. Okay, and again here, absorption is required by GAAP for external reporting purposes. But the problem is something can be a little misleading because it says, well, we need that to make the unit, except it's not part of the unit final product cost. And again, from alternative methods, the differences is a small percentage of total manufacturing costs. Sometimes inventories are low, or turnover is rapid. Again, like I mentioned earlier, the difference between absorption. Absorption, like the name says, it absorbs everything. Materials, labor, variable overhead, and fixed overhead. Variable costing, it doesn't ignore fixed overhead, it just treats it differently. The only thing we want the product cost, it says, is the actual things you need to make the product. Your direct materials, direct labor, variable overhead. The fixed overhead portion becomes a regular period expense. Just a regular routine expense. Just like say a monthly routine expense. And again, to compute your unit product cost, our direct materials, direct labor. And again here, we see the big, it's obviously a big amount, $600,000 here. So again, to get a variable overhead cost, take the 180, 6,000 units. So we know their variable overhead cost is $3 per unit. And if you notice, both of them have it in common. But the fixed overhead cost, nope. If you know it's variable, it's 0. So obviously, absorption is always going to have a higher cost per unit than variable. As we see right here. It's going to be 0 for a variable because they omit that part for the per unit cost. And again here, we see an example here. As we showed earlier. So we see here, the big difference here. And again here, if you notice right here, the cost rate of $34 becomes a period expense for variable costing. Here, just, lump it all in there. Like the name says, it absorbs everything. And again, let's look at how the income statement's used. Absorption, and one's using variable. And we see right here, notice that the income here in the absorption will be $580,000. And again here, that means units produced equal units sold. It means everything you made, you sold everything, gone. Under variable, it's also 580. This is because, remember, if they sell everything they make, it means you don't leave anything in inventory. It's all gone. They're always going to equal out because, remember, fixed overhead goes to inventory. Well, it's gone now. It's sold. So they're always going to be the same here. Again, and then it comes the contribution margin report. Again, if you notice, when they equal, it's when you produce equal units sold. Because, see, an absorption is $600,000, it goes to cost of goods manufactured. Here, just 2 is a period expense, and it equals. They're 100% the same. Now, what happens when the units produced, you made too many, exceed units sold. Well, now they're not going to be the same. Absorption will be higher. Okay, let's go over, see how it's going to work. So we see right here, income for 2016 is $320,000. Under variable, it's going to be $120 because that's $600,000 here. You see, it's a fixed expense right here. Okay, but now if you notice right here, we're not that $600,000 under variable. We don't omit it, but in the meantime, it comes over here under period expense. So variable, of course, will give you a higher expense. Now, let's say you didn't make enough. Units produced less than units sold. Income now under absorption is $840,000. Variable, it's $1,040,000. So it'll be a little bit more here. So again here, the difference is right here, that period expense. And the cost of goods, obviously cost of goods sold, is $800,000 here, fixed overhead. Here overall, you're going to get $600,000 because it takes it all into consideration to make the product. And we see the differences here. What would happen if, if you produce one more than the other? Overall, though, at the end, they all net out. It's going to be 0. Again, look at an example of 1. We look at here. What's the cost per unit? The cost income statement here. Now under variable costing. And compare. Okay, compare and go into variable cost and absorption cost basis. Okay, and again here, you want to use the formula. Comparing variable cost income to absorption cost income. So we see here, we must be adding back to fixed overhead here to restate it first. We must first deduct the fixed overhead. Recognize the beginning inventory, which occurred in 2016, but expense in 2017 and cost of goods sold when the inventory is sold. Sometimes, absorption costs can lead to overproduction. Okay, it's about 100,000 units instead of 60,000. Again here. If you notice right here, the more you produce, the cost goes down because the difference right here, fixed overhead. 600,000 about 60,000 units. Well, now if you're producing more, 600,000 divided by more units, which leads to a lower cost here. It's called economies of scale as you spread it out. And here's the problem, though. You have those 40,000 extra units to store in inventory. Per unit is $4 less. That's another reason why we see a difference. And we see different incomes here under absorption and, of course, with different times here. December 2015, and, of course, if units produced equal units sold, and, of course, in this case, you produce too many. See the difference in incomes here. When you produce more, it gives you higher income. Because, again, the difference is going to be per unit cost, from $25 to $21. Again, if manager produces 40,000 units and builds up any inventory. And again, it shows here manager can report increased income by just producing more. Even if you don't sell them or not, say, well, it doesn't matter if we sold them or not, we still got more income. Again, different units here, if we write it out. Under variable costs, and even if we produce more units, it doesn't affect it. So here variable cost says, no, we produce 1 million units. It doesn't affect it. You actually have to sell the units to increase your net income. You can't manipulate the statements here. And again, you got to determine selling price. Remember, when you look at anything you buy, from $1 to $1 million, it's not just a randomly selected price. You got to look at a lot of factors. Cost is a crucial factor. Again, you want to make sure your price is high enough to cover all your costs. You don't want it too high where people won't buy your product. In the meantime, you don't want it too low if you can't cover your costs. And again, what costing talks about is useful because it reflects full cost. Sales must succeed for the company to be profitable. Now, how do we set a price? So determine the product cost per unit. Determine the target markup. How much do you want the markup to be? Add the target markup to find the target selling price. Again, here we see absorption cost in. It says here 25 times 60% markup. So we see here, it costs $25 to make it. We sell $40. The market can be 60%. Imagine in terms of target markup, they show 60%. Add $15 to $25, you see it's $40. Here's a big challenge here. How do you control costs? And your manager's responsible for the controllable costs. Again, the whole point is, you can't control everything. Even if, you have some uncontrollable costs. It says, all right, what can the manager reasonably control? Production costs, by production supervisors, fixed costs. Again, costs not the manager's influence. And the production capacity, that's beyond me. It's higher up, or sometimes you just can't control it. Even service firms. Again, useful. Focus on the variable costs. From anything, from utilities to your hourly employees. Again, sometimes you may be specially ordered. It says, well, if you order 1 million units, we'll give you a better price. Again, here, look at an example of one. Some price, 30%. Markup is targeted, $60. Again, 30% markup. You want to add 18 to it. Somewhere to be $78. Again, $500 per night, actually sweet, costs $400. Here it says, sometimes you might say, let's say the group hotel rate. A lot of people will say, well, if I get a hotel rate, if I bring 100 people, will give me a deal, or if there's a conference in town. Can evaluate. It says, okay, how much can we make off each one if we give them a discount? And go be higher by $3,600 if we do this. Again, by special order sometimes. Again, you need special orders. Again, you gotta make sure you cover all your costs. This will provide, what's acceptable to the owners. Well, that will depend on the owner. Now, short run, the cost to maintain capacity and not change in production levels. Excess capacity. Again, it should accept a special order of 1,000 pairs of skates, $22 per price. Well, again, we've got to look at certain things here. It says, well, if we do it, we'll get an extra $5,000 incremental income. Now it's up to the company, should they or should they not accept it? It's up to them. Should be accepted because it costs $20 exceeds $3 variable cost per unit. All right, class. Hope everyone's doing well. Let me know if anyone has any questions. Okay, thank you.